All right, I'm switching over to video because a lot of people don't come to class. So here's the video. So we're not moving away from the stock market. We're just going to do other things while the stock market game continues. So periodically we'll check in, we'll buy some stuff, we'll sell some stuff, but we can't just do that every single day. So it's time to move forward a little bit. So we're going to talk about credit cards and debit cards. You watched the Ed Puzzle yesterday, hopefully, and understood that a debit card is connected to your to your checking account. So when you use a debit card, it's the same as writing a check. It's the same as taking money out of an ATM machine. That's what a debit card does. A credit card is completely different. They look identical. If you saw my debit card and my credit card, they look the same. But my credit card is just attached to my bank, takes money out. My credit card is different. Visa, MasterCard, American Express, these are all different companies that give you what we call credit. So today's just an overview of what that is, and then we'll get into a little more specifically how it works and interest rates and stuff like that. But so you're going to fill out these notes today. So generally, we just have, sorry, a credit card as being a card where you can buy something now and pay for it later. So a credit card literally lets you give your card to the person at the counter or put online purchases, and you don't pay anything today. So my checking account won't change. The amount of money I have will not change when I use a credit card to pay. And then at the end of the month, the bill will come and I have to pay that credit card or at least part of it. A monthly statement is something that you get every month when you have a credit card, and it'll tell you how much you spent that month on your credit card. And you have to pay some or all of it. They'll tell you what you owe for that month. Like they'll tell you all the money that you owe. And then they'll also tell you what your minimum payment is. So, first, the balance, to define the word balance, is the amount of money that you owe on your credit card. If you haven't paid all of the previous month's payments, that adds up and becomes an even bigger balance. So, the balance is how much you owe in total. The minimum payment is the money they require you to pay that month. So you might spend $2,000 on your credit card, and they only require that you pay $25 at that month. So that sounds really enticing. The problem is the interest rate is going to get you. So this is something we'll talk about really in depth, but the advantages of a credit card are that you don't have to pay right now. I can just have my card. I don't have to have cash with me or anything else. Just use my credit card, and then I don't have to pay any of that money until the end of the month. I can use it for big purchases. So let's say, I can't afford a new roof right now, but maybe that company will accept a credit card and then I can pay it in smaller amounts. Like if I have water coming in my house, I need a roof, or my car needs a repair. I need new tires on my car. I can't drive my car without new tires. Well, I might not have the $1,000 it costs for the tires. So I can put it on my credit card and pay it back more slowly. So at least I can get the tires now. So for emergencies, it's great. It also does something called building credit for you. So when you go to buy like a house, take a really, really big loan out to buy a house, you need what's called credit. So you need to show the bank that you know how to handle money. And one of those ways to build good credit is to have a credit card and pay it off as you go, or at least do your minimum payments as you go. One other small benefit of a credit card is rewards. So sometimes people use credit cards to build up points for flights or to build up. I just get cash back on my credit card, but don't get fooled. It's a really small amount of cash back compared to how much I spend. So the rewards are great, but they're not that great. The disadvantages are that you end up, if you don't pay off your balance every month, you end up spending way more for that thing you bought than the amount it cost. So, for example, pardon me, let's say you wanted to buy a PlayStation, it's $500, PS5, and you put it on a credit card. If you only pay the minimum payments, let's say the minimum payments are $25 a month, it'll take you forever to pay off that PlayStation, and it'll end up costing you way more than $500 in the end. So it's not a good idea to depend on a credit card to buy stuff, especially things like a PlayStation, because that's not a need, it's a want. Remember that category from the beginning of the year? Um, okay, So, yeah, so one of the other disadvantages is it's really easy to use a credit card to buy things you can't afford. Not good. So, we're going to go through. I want you to answer these true false questions. A credit card lets you buy something now and pay later. You must pay at least the minimum amount on your credit card by the due date. So you have to pay the minimum amount. You can pay more. What you hope to do is pay the entire balance, but you have to pay the minimum. If you pay half the balance on your credit card, you do not owe any interest. Not true. Unless you pay it all, you owe interest. Um, you can try this one. Number 10, the balance on your credit card is $78. You pay 60. Your unpaid balance is now 22. Is that true or is that false? And then 11, credit cards give you an unlimited amount of money to spend. Well, I wish we were in class to talk about this, but no, they don't. You only qualify for a certain amount of spending. So the more money you make, the more you qualify to spend, the better your credit, the more you qualify to spend. So you guys could not open a credit card right now and spend $20,000. I could, because obviously I'm a lot older and I have a job and I have built all this credit. In the beginning, your credit cards you won't get clearance or whatever permission to spend that much money. So that's our introduction, and then we'll start getting into some more of the details as we go.